We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Matthew Piepenburg, partner of Von Greyerz AG, and also the author of Gold Matters and Rig to Fail. Matt, thanks for joining me today. How are you?
I'm great, Tom. It's always great to be back and speak with you on so many changing headlines these days.
Well, you and I always have an excellent discussion, both on and off the record, right? I always really look forward to it. Mm-hmm. And today I want to start by kind of touching on three different topics and then what they all mean for the greater system, basically. You know, the Fed recently wrote about the idea of gold revaluation, and it was written about somewhat negatively. Do you think that this is, you know, the first official denial that kind of confirms that this is what they're thinking in that direction?
Yeah, I mean, it's a classic kind of, you know, DC psyop. You drop little seeds and then you kind of give for different tones and you telegraph something before it actually happens, and you try and read the tea leaves and make a case pro or con. I think gold revaluation is an undeniably important topic, and there are very, very different views on it. And to your point, there was a August report from the Fed, and there was actually a May report as well, already talking about how it's, first of all, the May report, what they called it, I think it was a manual or something. It was basically just showing that, you know, without getting into the math of the asset and liability side of the balance sheet, the Treasury and the Fed, that first of all, you can revalue. It can be done, and you can revalue gold to spot or higher, and then take that money and put it in the Treasury general account and pay down debts. That was kind of the first May salvo of, if we did this, it could be done. And then this later report that came out recently gave examples of countries like Curacao, or saying, you know, the Caribbean islands and Lebanon and South Africa and Italy and Germany. Well, others have done it too. So this is just another way of signaling we could do it. But the tone was kind of, as you said, not really super excited. They said it doesn't really solve the larger structural problems, even if we did something like this. And yes, there is precedent, et cetera. If there was a revaluation, it wouldn't be so shocking and we wouldn't be the only ones, kind of apologizing before the fact. So there's that kind of tone, to your point. And then, you know, then there's the pro case, or the gung-ho case that this is an inevitable Hail Mary that we have to do. And then there's the case that this will never happen. I think before I give my opinion, we should look at both sides, because anyone who says they know, whether it's Judy Shelton or me, I would be distrustful of, because no one knows exactly until it happens. I think before we even get into a pro and con case, Tom, I mean, first of all, we need an actual freaking audit of the gold in the U.S. You know, you can audit Fort Knox, you can audit West Point and Denver Mints, et cetera. They've been saying that's too complicated, it's too expensive.
I was going to say that's going to take a lot of time that we have to. It
does, but before you revalue something, we have to know how much we have. And, you know, I think there is the World Gold Council report. Of course, that's relevant. We've got about, according to the World Gold Council, we've got about 8,131 tons. France and Italy have about 2,400 tons, which is more, they say, than China has. And with Russia, we don't even know. It just says not available. So the very first question, and we could talk about how that's crazy, but let's just assume America has what it has, you know. And when we don't know, there's a lot of momentum in the headlines and the clickbait now that we have significantly more than the 8,000 approximate tons, because we've got a lot from Saddam Hussein or from Libya, and we certainly may have a lot more because of what we took from the Japanese after they pillaged China. There's all these hidden trusts and gold kind of vaults that we don't know about, that are unreported. And that starts, again, I keep saying, that starts to sound like a Tom Clancy novel. And the truth is, we don't know. I think before we'd revalue gold, I would want to make sure we have a lot more than the Chinese or the Russians, so we can get into that. But, you know, in the case of revaluation, you know, it's important to keep in mind that it would in some ways make sense. You know, Michael Hartnett at B of A says we really don't have much choice. You know, we can't attract buyers of our U.S. treasuries anymore because we can't give enough yield or coupon and yield because that would crush our own ability to pay back our own debt. So we can't really make U.S. Treasuries effective. We can't keep monetizing our debt that way at higher rates. So we need this Hail Mary. And if you look at it in the context of where the U.S. is, we've got 28 trillion in U.S. Treasuries that is going to be due in the next 3 years by 2028. So how are we going to pay for this? If there's, since 2014, the world's been net sellers of treasuries and net buyers of gold. Who's going to buy another 28 trillion of U.S. IOUs at our current debt levels and at our current, mood about America in the global kind of geopolitical space? How is that going to happen unless we have some serious liquidity? We've got at least 3 trillion in deficits annually and against 5 trillion in asset and tax receipts, and we still run these 3 trillion or even 4 trillion potential deficits. So we need some type of emergency piggy bank here, and a revaluation of gold could be the answer. Now, of course, if you take the 261 million ounces that we say we have and we revalue that at spot, and even if spot is at 35 or 3600 when we revalue, if we revalue, that's for easy math, let's say $1 trillion, just revaluing our $42.22 certificates and bang, $1 trillion, but that doesn't even cover a year's interest on our debt. So is that even really a Hail Mary solution? It wouldn't be. Mm-hmm. What would be a Hail Mary solution is if we didn't just revalue our 261, gold certificates at spot. It would have to be at spot plus a significant amount. That we would basically be creating a new floor in the gold price. And mm-hmm. And many people may know that if we revalue gold at 4,000 an ounce from where it currently is, that gives us an extra trillion. If we did it at 10,000 by fiat, just gold is now 10,000. The Treasury's made a bid. The Fed's going to pay it. There's $10,000 gold overnight. That would give Uncle Sam another 2.5 trillion. And then the number that Jim Rickards and others are throwing around is $24,000 gold. That gives us, I think, 6 trillion. Now, okay, on a pure balance sheet, without getting into other consequences, 6 trillion would bring down America's debt to GDP pretty significantly. It would buy us time. It wouldn't solve everything. If we brought down our debt to GDP, as myself and Luke Roman have always said, we won't get growth. We won't get reshoring. We won't get anywhere until we reduce our deficit or debt to GDP. So this would be a way to do that. On the pro case, I mean, again, this is looking at all the positives. And so, and by the way, Roosevelt did it in the 1930s. Nixon did it twice under his administration. We did revalue gold, but nothing this significant. I'm just saying you could argue on the pro case that it can be done. And then you've got our vice president talking about Triffin's dilemma. We're in a position now where because we're the world reserve currency, our exorbitant privilege is no longer our currency, your problem. It's our currency, our problem. We need a weaker dollar to compete with exports. The years and years of arrogance with our policy and inflating or exporting our inflation to the rest of the world was wonderful for a 50-year window, but man, now we're paying the price. So Vance is kind of suggesting we need to come up with some solution. Gold revaluation floats under that umbrella. Scott Bessent has talked about monetizing parts of our balance sheet, our assets on our balance sheet. Well, they're not going to monetize mortgage-backed securities. They're not going to monetize U.S. Treasury. So what's left? It's gold. So you could say those are signals that the U.S. is looking to monetize its gold certificates. And then again, the question is, will it be at spot? Will it be 4,000, 10,000, or 24,000? Obviously, as a gold owner, any gold owner would love to say in a vacuum, boy, $24,000 gold overnight sounds great to me. But I actually would argue, as Alistair McLeod, our most recent advisor at Von Greyerz, has argued, there's a couple of problems with that. Look, and even before I talk about Alistair's point, in which I agree with in some ways, there's Kissinger's famous warning too. And he talked about this in the 70s and 80s. If you go with this kind of cliche that he who has the most gold wins, and you revalue gold, well, of course, if America has 8,000 tons and China only has, 2,000 plus tons, then we would be certainly the winner. But as Alistair has argued years ago, and he did a pretty good study on this, it's off the records and none of us know for sure, but we think it's safe to say with China as one of the largest gold creators, with its ETF space going from 20, it's tripled in the last year for consumer buying of gold in China. The banks encourage their citizens to own it. They refine it. And they don't report it accurately. I don't think it's clickbait stretch to suggest that China probably has closer to 30,000, not 2,000 plus tons, a significant amount more than the U.S., unless, of course, the U.S. has some secret system. We don't know. That's what's so crazy. We're talking about these things we don't know. What I'm very confident in, though, is that China has a heck of a lot more than the World Gold Council is reporting. That I have no problem saying. And again, without an audit, we can't really know for sure the deck or the poker hand the U.S. could play here. But what Kissinger was warning is be careful what you ask for. If we tried to make a new piggy bank out of our gold certificates, which, as Andy Schectman reminds, the actual name of the Federal Reserve's gold certificates is called the reevaluation, the gold reevaluation account. I mean, you can't make this stuff up. So the idea is it's there to be revalued at some point. If we revalue and create a new price floor, whether it's 10,000 or 20,000 or 24,000 an ounce, if you think that's not going to be it's going to be the same floor in the Shanghai exchange or the SPIMEX, the St. Petersburg exchange, you can't have a 200 moving day average in London and New York that's different in Asia. And if Asia and Russia have more gold, then the U.S. loses immense leverage in the global economic landscape because he who has the most gold wins. And what Kissinger was basically suggesting is we don't have the most gold. And again, the truth is none of us know. I'm very, very, and this has nothing with my bias, but I'm very much, in fact, if I were biased, I'd say we're going to revalue gold. It's going to go to 24,000. That's great for me and any gold owner. But I think be careful you ask for, because if China has as much as we think, and many think, then we would lose a huge amount of leverage because I think China would have far more. And already with what the BRICS are doing and net settling with gold as part of not their gold-backed BRICS currency, but kind of this basically a gold as a delta fixer in regional trades throughout the BRICS nations and all the trade agreements in the East, which basically covers 75% of the population. Gold is already critical as a settlement asset, not as a backed currency. So if we revalue gold unilaterally out of the U.S., I think we get punched in our own face for our own policies. And I think what Alistair has said too, when it comes to revaluation is, look, that would really destroy the U.S. dollar. That would probably take 50% off its effective value overnight, and that would lead to massive inflation. And again, pick your poison. Is that the kind of necessary destabilization and pain we'd need to get out of a crisis? We have to create a crisis first, weaken the dollar, reshore jobs, admit to a whole new normal overnight, and then from that rebuild slowly. I don't know. I just think a major gold revaluation would be an absolute confession that we are so in a corner that we're even considering this. And then if we do it, which could be done, we're willing to gut the U.S. middle class in particular and absolutely debase the currency at such a level and try to reshore jobs in the rubble of the dollar, in the rubble of our global hegemony, which is already deteriorating. And that, necessity is the mother of invention. Desperation is the mother of bad or good choices, depending on how you look at it. But it can't be done smoothly and easily, no matter how seductive the headlines are. I guess that's what I'm saying, Tom. So there is a case to be made, and brilliant voices in the space like Andy Schectman or Michael Hartnett at a major U.S. bank, or even you could say Scott Bessent and, you could argue Vice President Vance are flirting with some type of revaluation. We just don't know the scope, the price, and the true value of it until it actually happens. But I do think Alistair McLeod and others and myself and Henry Kissinger, who I'm no fan of, you can't ignore their warnings either. So you're looking at two different arguments, neither of which are very good. And anything's possible in what I consider the most desperate geopolitical and global macro environment I've ever seen or studied right now. And that isn't even a gold bug case. That's shared by pretty much anyone who's paying attention to the debt levels and the currency issues, and not to mention the geopolitics right now. And that is not an exaggeration. So yeah, Tom, anything's possible right now.
Mm-hmm. Yeah, I think it really just comes back to this idea of really just showing your hand. And I think that's what the ultimate, I think, draw to holding gold is that it is just the nature of it is the opacity with which you can kind of hold this wealth and don't necessarily, that nobody technically knows exactly what you have, right?
Right.
and
Precisely.
and doesn't show your strength. But
Right.
you mentioned in there this idea of the attractiveness of U.S. debt, and of course we've just seen the Genius Act be passed. Is this something to be far more skeptical of than just another innocuous bill? And
Yeah.
is there a way that this does create more demand for U.S. Treasuries?
Well, absolutely. It is a desperate but understandable act to create synthetic demand for an otherwise unloved U.S. Treasury. It is, because the stable coin, which we can get into, is neither stable nor a coin, and it is an e-dollar issued by fintech names like Circle Internet or Tether or JP Morgan, commercial banks that will give you an e-dollar backed one-to-one with a U.S. Treasury. By buying or e-coin or being issued an e-coin, you're effectively subsidizing indirectly the U.S. Treasury market, which of course you can understand given how unloved U.S. Treasuries are. And this is on the short end of the curve, which is more loved than the long end. So in that regard, it's a kingmaker for Tether and Circle Internet. I mean, Tether makes more profits per year on stablecoin than Citibank or BlackRock, for God's sakes. I mean, it's massive. And it also means that Tether is now the 18th largest lender to the U.S. government. So of course, it is a way of creating synthetic demand for U.S. Treasuries. But again, as my point is, that's just the first. It's just the first observation on stablecoins. And to me, a Genius Act like the Patriot Act or just about anything that comes out of D.C. means the opposite of its title. And that's not being cynical. It's really fascinating, the oxymorons, whether it's stablecoin, the Genius Act, et cetera. But it's not stable either, because if it's backed by the U.S. Treasury, even at the short end of the curve, the volatility of the U.S. Treasury, is anyone who's paid attention to the bond market, which is really boring. I get it. We've seen massive signal moves on the short end of the yield curve just years back when no one talks about that anymore. But the stable coins is only as stable as the Treasury behind it, and that is probably the least stable asset you could imagine. But again, that isn't discussed in the Genius Act. The other thing that's not discussed in the Genius Act is the issuer of this coin, or the banks, certainly basically get free money here, because the user of the e-coin gets no yield, especially from the fintech companies legally, they don't get any yield. They just get an e-dollar. Meanwhile, the issuer goes and buys U.S. short-term duration treasuries, probably less than 2 months, at 4.25%, and they take that yield, which is why Tether and JP Morgan push for this, because they just made themselves extremely rich. And what does the end user get? Nothing. No, just an e-dollar, which is backed by something very unstable. And to add insult to injury, they also get a very highly programmable, trackable, and seizable electronic coin if things go wrong. So it is CBDC, just instead of being issued by a central bank, it's issued from a commercial bank, which is tied at the hip of a central bank, and through fintech companies. So it's not only not stable, it's highly trackable and seizable and highly centralized. And so, yeah, the winners are the issuers. The winner is the U.S. government. The loser is the end user. Nothing new under the sun there. And that's not being cynical. It's just the plumbing's meant to be complex. The title's meant to be misleading. And for good, naive, trusting citizens, they think it's a stable coin. But for all the reasons I just mentioned, it's not stable, but it certainly makes Uncle Sam a little happier. Proves how desperate that they are, that they're needing another source for, again, synthetic demand for an otherwise less loved U.S. IOU. And meanwhile, JP Morgan and these issuers are going to make a lot of money on this. It's fascinating, because really it's banks pay 0% and take 4%. That's a great trade. I'd take that all day long.
Hmm. Yeah, it's incredible how profitable Tether as a company really is, especially, profit per employee on any metric. They're making just tons of cash. But, on the other side, I do see some of the positives of it. If you're in, let's say, Zimbabwe or, any other, even Turkey, for example, that is, going through this massive inflationary, value losing time in their currency. And you have the option to trade your lira, for example, for a less shitty version or a less shitty currency that's losing at a slower rate than yours. I mean, that does make sense. So it's just such a complex situation with some positives, but at the end of the day, you still have to remember what is actually holding that value, right?
Absolutely, and there's no arguing that the speed and efficiency of digital ledger technology or blockchain technology, there's no denying that. And I'm not even trying to criticize it across the board. There are safer versions of it in different versions. You get Bitcoin versus Ethereum. There are different safety valves in that and different risks, and stablecoin certainly has an efficiency ratio and a speed ratio that you can't compare.
Mm-hmm.
But again, that may not bother. And certainly people in third world or developing economies will take that any day over the risk they're facing. So you can't ignore those positives. And it's a personal choice, and many people won't mind. I just personally don't like having a trackable asset. Not because, again, I have something to hide, but I have privacy to protect. There's a difference. If you're transferring arms, drugs, or human beings, and you're using technology for that. But if you're just a desperate poor person in a third world or developing economy, you want a more efficient coin, it makes perfect sense. For many of us, though, who have the choice or have the liquidity, I don't like the centralization that's really the behind the scenes of all of this. This is, as I've written and said, and I'm not alone in this, it's just central bank digital currency by another name. It is still a wolf in sheep's clothing. It is still frog boiling the world towards more centralized control. Now, some people probably don't worry about that as much as others. That's a personal issue, and the efficiency side of it is undeniable. And so that is a conclusion each of us have to make for ourselves. Yeah.
You know, it's interesting as I was having this a very similar conversation the other day, trying to wrap my mind around this, trying to, understand it for myself and the audience as well. I was thinking that, is it possible that this replaces the SWIFT system? We have a US stablecoin system that is, to your point, extremely efficient, or far more efficient and far more effective in a lot of ways than the SWIFT system. So, these legacy systems do need to be improved upon. And again, that's I think the challenge of understanding stablecoins or any of these ideas is taking the good as well as the bad and being able to make a rational evaluation of it.
Yeah, for sure.
But I mean, go ahead.
I was going to say the SWIFT system, absolutely. All of these things are facing revolutionary change right before our eyes if we're paying attention. The BRICS bridge is basically replacing SWIFT. Absolutely. The BRICS had the SIP system that came in years back when the de-dollarization started. And what the BRICS are doing, including the Belt Road Initiative countries, is they're basically, they've got a gold-backed settlement currency, not a gold-backed BRICS currency. And that is transferred without the SWIFT system. It's significantly lower costs. And the SWIFT system was a key part of the exorbitant privilege of the U.S. dollar. It was the dollar was part of the petrodollar, still is, but less so. It was part of the international financial exchanges, intrabanks. So these massive exorbitant privileges the dollar enjoyed for most of my life are changing right in front of our eyes, including this SWIFT system hegemony, which is objectively changing. And so, yeah, Tom, these are just more examples of as things get more and more desperate, not just from the gold bug camp, but objectively for the dollar, for the U.S., whatever your party or partisan thoughts, whatever your love or hate relationship is with the current or last president or any other president, you have to look at things past the partisan lens and look at the math and look at the actual rotation of money, the way it's transferred, the way it's held, the good, the bad, and the ugly of all those things. But no matter how you turn that, it is clearly changing, including the SWIFT system, which was so an essential pillar of dollar hegemony. That's undeniably changing.
So, Matt, the last time we spoke was in March, and since then we've seen several tariff announcements, retractions, adjustments, redeclarations from Trump. Would it make a difference, do you think, to have made many of these new deals in a more predictable and less chaotic way?
Well, again, obviously, that's getting to my point. You don't want to insult half the audience who are going to have a partisan view. We all have biases, political biases. Even if you're libertarian, you have a bias. I think each of us could spend an hour coming up with a long list of just embarrassing things about the Democrats in the last administration and a long list of embarrassing things about the current administration. And again, it really, I think like many of my clients, we're well past left and right now. Things are so bad. And I've said many times, there are major differences, of course, between not just the Democrats and the Republicans, but Trump versus Biden in personality and speed of thinking and in decorum. You got to look past that. Ultimately, the RNC, the DNC, Republicans and Democrats traditionally, to me, are just two stirrups to the same saddle. Ultimately, basically riding the same horse of deficit spending for the near term and leaving a huge inflationary bill in the long term, and they're all guilty of criminal negligence with our monetary policy. You can't even blame the Fed for what the House spends. The Fed has to figure out what to do with it, and I'm no fan of the Fed, but even they can't predict or necessarily control how much reckless spending has gone on. But you could say they encourage it by monetizing the debt. But to your point on, is Trump's kind of what Egon calls shoot from the hip, Dodge City tariff policy through social media, could it have been done a better way? Well, obviously, because it's far more disruptive than just claiming tariffs or spitting out a tariff or starting with, in the example of Switzerland, for example, well, 39% tariff on most goods, but not gold. And then by July, well, it's going to be gold too. And then that changes in 3 or 4 trading days. And then it creates so much disruption in the Swiss case as just one example. I mean, you could look at aluminum, steel, wood, pharma products, anything. But in the Swiss case, I mean, look, refining is a precision industry in Switzerland. We were talking about it offline, and whether people know this or not, the vast majority of LBMA and exchange level quality gold, which is so precise, is refined in Switzerland. It's not dug out of the ground in Switzerland. It's a major part of the industry, and it's a major part of the gold world. And if you have this kind of shoot from the hip tariff to test out how strong you are vis-a-vis this engine of gold, which is Switzerland, and gold is now such an engine of the world, changing from fiat to something that stores its value better than. And then you throw that kind of salvo over the bow of a small little country like Switzerland to see who has the bigger bargaining power and the art of the deal. Even if it's for 3 days, 3 months, or 3 years, that kind of instability is dangerous, because even if the Swiss even respond with a small levy, they got a 39% tariff, which by the way is now gone. But even if they responded with a small 1.2% levy, well, that has a massive impact on the premium for gold or silver. But it's particularly at gold. If you get a $15 rise in the gold premium because of the chaotic nature of these tariffs, well, that means a 15 to 20 basis point yield spike in the US. It just does. And that makes the dollar actually a little bit stronger on a relative basis, which then actually hurts American exports, which is the ironic twist. So, I mean, you can pull on different threads. That's just in the gold space and in what Switzerland can do with gold. We're not even talking about every other kind of asset or good. But, that policy of shoot from the hip is destabilizing. You could argue it's meant to just create chaos. From then you then show your power, what you're willing to do, and then from there you get better bargaining. That is up to everyone who's read The Art of the Deal, whether it was ghostwritten or not, to decide if that makes sense. Historically, it doesn't. And again, does history rhyme or does it repeat itself? We look very similar and not identical in 2025 as the U.S. did right around the McKinley era with the Smoot-Hawley Tariff Act. We talked about it a million times. It didn't end well for our government. It didn't end well for Smoot-Hawley or McKinley, and it didn't end well for the U.S. economy. Now, there are many differences today, and there's also, in all fairness to Donald Trump, he's not the only bully to institute weaponized tariffs or protective tariffs. China hid behind a 25% tariff wall for years, protect its auto industry when we had a 2.5% tariff. And Europeans who have every right to be upset about these bully tactics from Trump forget that we have a value-added tax in Europe, which is basically a tariff. It's a 20% cost. It's really, you could argue, a tariff. But the larger question is, are tariffs even effective? And to your question about the policy through social media, these whipsaw tariff policies that are very destabilizing exist in the gold example and have ripple effects just in the currency and the bond markets and in the export markets. I'm not making these up. These are just objective ripple effects that we can track. Is it even legal does someone in Europe say, well, look, if even European experts and even courts in the U.S. are challenging the legality in 11 jurisdictions about these tariffs? Article 1, Section 8 of the U.S. Constitution. That's the first article of our Constitution. In addition to saying gold and silver is money and not fiat money, which we've nailed in the coffin, is now dead post-Nixon. But they also say that tariffs like this are the domain of Congress. So if Trump is doing this through Executive Emergency Act that has a finite duration, the recipients of these tariffs, you could say the victims of these tariffs, depending on your view, can't even make sense of how to paper a deal or a tweet from social media and know how long these are going to last and whether they're even valid and how they're going to react. And again, that's just one more example of the world, rightly or wrongly, depending on your views on Trump or tariffs, really don't know how to make senses and wondering if they're even legal. Then there's the larger question, regardless of the academic legality question, is are they even effective? And there's, again, pick your camp. There's pro case that says, look, we're getting hundreds of billions recently in trade deals and external revenue service revenue from these tariffs. This is a great idea. Look at what we're doing. That's true, but they're ignoring not just the studies out of Zurich or Yale that say these tariffs, yeah, you're getting some revenue on the tariff side, but you're losing at least a percentage point in GDP growth. If you lose a percentage point in GDP growth, consecutively, you get into an official recession, which is really bad for a bubbling stock market and an economy really sustained by debt. And by the way, we're also, we're quarterly borrowing at the U.S. at $1.25 trillion. That's like a possible $4 trillion budget deficit on a $30 trillion economy. So that's 13% deficit to GDP in a worst case scenario. If we're growing debt by 13% a year and we're growing a GDP at 2 to 3%, that's unsustainable. So in the backdrop of these hard mathematical facts, will whatever revenue we get from tariffs in any way supersede what we're losing in GDP and deficit spending? And that is, again, why Luke Groman and I are in complete agreement, and I totally agree with Luke, that you can't solve the debt problem in America with tariffs or the Wizard of Oz until you solve the debt problem in America. Mm-hmm. And you can't grow out of that debt with debt this high. You need at least below 100% debt to GDP to grow. That's just a math fact. That's not even a partisan fact. And so, like Luke said, address the deficit, address the debt to GDP before you launch policies, whether it's stablecoin, whether it's tariffs, whether it's gold revaluation, whether it's a gold-backed U.S. Treasury. Those are exciting, energetic, but guppy solutions to a whale of a problem. You need to get the debt to GDP down below 100%. This is math. It's not even a model. Those are mostly useless. This is just math. And so the only way to do that, other than a gold revaluation at 24,000, which I said has a lot of negative side effects, would be to cut entitlements and military spending at such a huge level, because that's very politically hard to do. This is the debt trap America is now in, because if interest expense on U.S. Treasury debt alone, which is now over $1 trillion a year, which is more than our military budget, the interest expense, the military spending, and the entitlements are now at such unsustainable levels that's where you'd have to make the cuts, though, to get deficit or debt to GDP down. Again, this is neither left nor right, gold bug or Bitcoin case. This is just math. You can't cut military or entitlements by 40% and survive politically. And so that is why we're in this trap. I mean, I think it could be done, but unless you do that, none of these policies, left or right, and this, again, it's not even a negative case or a nihilistic case. None of these policies ultimately are going to solve the problem, including a massive gold revaluation. That would buy the fastest amount of time and postpone the hangover that we're due and already in some ways vomiting from. But again, even a massive gold revaluation is going to create a ripple of all kinds of other catastrophic problems. So this is my point, that, and I'm a broken record on debt, and I can give all the data on debt. It'll make people's eyes roll over. And I'm not saying this pro-Trump or pro-Democrat or anti-Trump or anti-Democrat. I'm saying this pro-math, pro-common sense. Again, our clients are pretty sophisticated. We're past that point, folks, where anyone's going to save us. Not the end of the world, not the end of the dollar, but it is not sustainable. And so these tariff policies, even if they're effective, none of these things are going to work until we get our debt to GDP down. And at these historically unprecedented in the history of the world, in the history of capital markets, these debt levels are significant and they are in uncharted territory, and there is no easy solution. And so everything we're seeing, again, the juicy headlines on tariffs, the Genius Act, gold revaluation, a gold-backed U.S. Treasury at the long end, stable coins, all come back, Tom, to the very boring themes that folks like myself in our industry have been talking about for 5 years. Debt, bond markets, stock markets, the de-dollarization, inflation debates, and precious metals. Those are the old boring pillars, and they have not changed. Those are the key themes. They're the key themes, but they're getting bored. It sounds like a broken record. It's just the magnitude in each of those pillars: the debt, the de-dollarization, the bond market, the stock market bubble, what's happening with yield, boring stuff. Those are all still the key themes. They just gotten worse each month and year you and I speak. They just keep getting worse. And the headlines that we're talking about now are just symptoms of that same problem, Tom. It's just the same problem.
Mm-hmm. Matt, I want to push back a little bit here because obviously I totally agree that the U.S. is on an extremely unsustainable course, as is the world, as is any of these fiat debt-based systems. And in my time learning about the monetary system, I've continuously been wrong. The people I've been listening to have been wrong about the idea that we're at the end of the road, that things are about to collapse. And yet we're continuously, I dare say, impressed by their ability to kick the can down the road and avoid this day of reckoning. So because of that perspective, if we were able to, let's say, implement this strategy of Trump et al. Here over the next decade, let's say, is there a possibility that this could work, let's say, with the combination of oil being this low and or lower, that would be, help with deflationary forces within the economy? Is there any way that this strategy could be effective if given enough time to work? Or is it, these new policies are just showing that level of desperation for the system?
Look, it's a refreshing question, and I welcome it, because I too am. Look, I'm nauseated by the constant clickbait, even of videos that I've recorded elsewhere that are reposted with Piepenburg says end of the dollar, end of America, end of the world. None of these things mean any of those things. I want to address your specific question: how could it work? Is it just desperation, or is it an audacious, effective policy that we need to consider? And you got to at least give credit for Basent over Yellen admitting we have a debt crisis. You've got to give credit to a president, love him or hate him, who's trying just about everything under the sun to shake things up. So you can, and nor do I think the world is going to end tomorrow, or that America is going to be a third world backwater, banana republic, and everything's going to end, and it's going to be guillotines in New York and war and revolution. What I'm saying is the next 10 years are going to be much harder than the last 10 years, and that's not even a prediction. It's already happening. What's the watershed moments that have happened to the middle class, the wealth inequality in the U.S. in particular that I personally witnessed, the need for reshoring because of the offshoring in the Rust Belt states where I'm from, the death of the middle class, the objective rise in small business bankruptcies, and the objective decline in the purchasing power of the U.S. dollar, the objective decline in the living standards of most Americans, who Walt Whitman described as the backbone of any country as its middle class. They are the working poor objectively. And so, in my opinion, it isn't working. It hasn't been working for quite some time. So that's not meant to be nihilistic or apologetic. That is, to me, objective. And I think for many of us who enjoy the privileges of being at least somewhat financially secure for now, we don't see suburban Ohio, suburban Michigan, Pennsylvania, where buy now, pay later programs are at all-time highs, where credit card delinquencies are at all-time highs, where car repossessions are at all-time highs. So that is the real America, or the real Canada, or pick your place, but particularly in North America. No, that's not me predicting gloom and doom. That's actually happening right now. It's actually happening. It's not even predicting the death of the dollar or the DXY going to 50, but the purchasing power of the dollar since the day I was born, $100 now buys you $13. That's a slow drip reality. It's not a gold bug case for precious metals. It's an objective measure of the debasement of our currency in one lifetime. It's an extreme debasement. So first, I want to say a lot of the negative things that you could say data mine as opposed to data analyze are undeniable. You can make a pro or con case for that. It's hard to make a pro or con case when 20% of Americans, their entire salary for their first job goes to paying rent and they take a second job to pay for anything else. Now, that's a meaningful percentage to me. It's hard to deny the bankruptcies. It's hard to deny what rate hikes did to the lower income businesses, while the bigger companies with easier access to capital and credit thrived and violated every antitrust principle I studied in law school. Because what we have now is feudalism in America. We do. Objectively, mathematically, the top 10% own 90% of the stock market, and the middle class is ignored and scraping by to get through the month. I know that because I come from that middle class and I talk to people in that hometown, and that's how they're doing it. I get choked up because they literally are washing cars as side jobs. People, 60% of Americans didn't go to college. And I'm not even talking about what AI is going to do to white collar jobs. But these things aren't meant to be gloom and doom. They're just happening. They're just out of sight, out of mind. That doesn't mean the whole America is on its knees and desperate to get through the day. But a large part of America is struggling. The dollar-denominated debt that Americans hold and the purchasing power of their currency is objectively destructive. It's destructive to them. And the future is incredibly precarious to them because we're not officially in a recession, and at least their 401ks are in a bubble, so there's something. But again, we'll talk about market risk if you want. But that doesn't mean the next 4 years we won't see a mean reversion in the market on top of already a debased currency and a very precarious U6, U3 employment numbers. I mean, Trump firing the head of the BLS was classic, because the data was so bad. But ironically, I have written about the BLS for years, making fun of them for being too positive. Finally, they give some real data on revised labor data, and he fired the guy for it. I mean, this is only Trump could do that. But I guess to your point, Tom, yeah, let's get away from the gloom and doom. Let's stick to the facts. Each of you and each one listening can decide for themselves whether these data points are good or bad. I think they're bad, but if you live in Greenwich or Palm Beach or Silicon Valley or the south of France with frickin' polo pony pictures behind you, it's very hard to understand what someone in Toledo, Ohio is going through, or Flint, Michigan. And honestly, I speak to those people as much as the high net worth clients I have to talk to every day, because we're still all Americans or citizens of the world, and the currency debasement isn't gloom and doom. It is happening right in front of our eyes, and the small business, working poor, middle class are suffering. That's not right in front of all of our eyes. And so, I do hear you in terms of could there be a solution, despite these empirical, to me, signposts of a very already on its knees working poor middle class and a very precarious employment market and a very bubbly stock market. Is there still a way out? Because to your point, everyone's talking about the end of the world for years. It hasn't happened. I don't think the world's ever going to end, but there's a lot of things that have ended. But could we somehow thread the needle in this backdrop where global debt, since I graduated from law school, has gone from 30 trillion to 300 trillion in just that short period of time, where it's not just a U.S. problem, it's a global problem? Is there a way that we can grow our way out of that debt crisis, cooperate with our currencies and our trade policies, avoid major wars, bring our spending to reasonable levels, and somehow avoid a 1929 globally or a Nikkei in 89 in the US? Is it possible? And of course, I can't say it's impossible, but based on history and math and the cycles of gold and the cycles of currencies, what we're going through now isn't the end of the world. It's just another classic credit cycle coming to an end. It's that simple. It doesn't mean the end of the world as we know it. It just means the good times that I've enjoyed as a kid of the 80s, for God's sakes. I mean, come on. When I graduated from college or grad school, life was like a menu. You could just choose it. You could afford a house within 3 years. You could get the down payment. Rates were this. For my children's generation, even if you're working at a good company with a good salary and you're trying to save 20% down payment on an overpriced piece of real estate with very tight credit, it's not the same. And so Can we get back to the generation that I enjoyed and the lifestyle I enjoyed on deficit spending? By the way, thanks to Ronald Reagan, my neighbor in Stevensville, Michigan, was his budget officer, and he was a true blue Republican. But he said we just took our debt levels off the charts. We broke 1 trillion in 1980. By 1995, we had 15 trillion. By 2020, we have 37 trillion in debt. That is temporary prosperity. That makes it look like it's not the end of the world. That makes it look like we're surviving. But no, debt-based growth is another oxymoron, like the Genius Act. Debt-based growth is not growth. It's just debt-based growth. And you do have to suffer the consequences of that. To your original point, it's not the end of the world. Will it be easy? Can we thread the needle? No, we're already failing to thread the needle. And in my personal opinion, tariffs, stablecoin, centralization, that's nothing new. It, to me, is not going to solve this without some type of what the Austrian economists call constructive destruction, not just the slow drip death of the middle class or the US dollar or credit tightening and buy now, pay later loans. There's credit card delinquencies and car repossessions, which are appalling in number. U.S. credit card debt in America is over $1 trillion. That's appalling. Margin debt on the stock market, over $1 trillion. That's more than the great financial crisis. That's more than the dot-com bubble. This is just objective facts. Take from that what you wish. But to me, that's not going to be solved. We're not threading the needle. We're going to have constructive destruction, austerity, a weaker dollar, a harder time of it. I look forward to that. Like Ed Dowd said, if Trump really wants to save America, make it great again, let's have the hangover. Let's stop postponing it. That doesn't mean we're all going to be crawling around with food stamps and it's going to be the food lines of 1929. Those food lines are there. They're just harder to see because they're invisible, but they're there. And I'm saying, long answer to your question, Tom, no, there's no easy way out of this. But yes, you're right. The gloom and doom, constant reporting of at the end of the world, that's nonsense. It just means a harder world, just like with a family or a business that's gone too far in debt. You have to tell your kids, you're not going to Disney, you're not getting the new Dodge, we're not buying you the fancy red bike, and we're not going to Hilton Head either, because we have to cut back. And then we have to, maybe both parents have to get a job, but many parents do, by the way, because we need more income and less debt. And as a nation, that's very hard to get elected on, saying that. And that's very hard to stay in office saying. So we, in the meantime, will pretend the Fed can save us with a thermostat with rates and balance sheet, and that tariffs and Doge and US aid and other things are going to save us. When I'm saying with all due respect, no, they won't. And they haven't, and they're not.
Well, it's funny, as you were explaining that, I was just thinking to myself, this would be let's say, the first example that I would be aware of in history where they were able to save the system and be able to actually turn that, let's say, that can upside down.
Yeah.
But, as you, after that, as you made the point, history always does rhyme, right? So
it does. Yeah.
What are the symptoms that are showing this evidence to the contrary? Debt markets, you mentioned the inflated equity markets. Mm-hmm. Are these the symptoms that show us that this is the untenable situation?
Mm-hmm. Well, I mean, look, one of the most obvious symptoms, again, is just the U.S. dollar, right? The U.S. dollar, you can say measured against a milligram of gold, has lost 99% since Nixon welched on the gold standard in August of 1971, 54 years ago, literally almost to the day. That's a symptom. Another symptom we all know is that when you come up with modern monetary theory, this wonderful model that says you can have deficits without tears, that you can print money to monetize your debt with no consequence, and that has solved the debt crisis. Well, it hasn't solved it. It's debased the U.S. dollar, but it also has created another huge risk, which we think paradoxically is a huge upside for America. And what we've done, especially since the great financial crisis of 2008, is created the largest, most untenable market bubble in recorded history, and called that success for the U.S. economy. Again, first of all, you have to be very clear that the stock market and the economy are not the same thing. They're not. And the vast majority of people enjoying that are the uber wealthy, top 10%. But to your other point, many middle class workers with 401k programs or pension funds are enjoying the near-term benefits of a rising, seemingly immortal S&P, Dow, and Nasdaq. And you could argue that's a sign that despite everything, we can chug on by. But the other symptom that things are breaking down is the very fact that we are seeing probably one of the worst and most empirically dangerous stock markets in recorded history, other than, say, Nikkei in 1989, which was trading at 69 multiples. Right now, the S&P is trading at 49 times earnings. But I think the narrowness of this market, led by 7 antitrust violating monopolistic feudalistic powers, which are 40% of the S&P's market cap, is not, to me, a positive sign. And I look at Jeremy Grantham. When I was in a family office, I allocated a lot of money to GMO after I had made a lot of money in the dot-com bubble. And when I was making money in the dot-com bubble, I was an absolute dragon-slaying moron who hardly knew a stock from a bond. I got into pre-IPOs through connections that went up multiples, much like the generation of the Bitcoin crowd is making multiples. I was one of those guys you'd love to hate. And I was looking at 300, 400% returns on my hedge fund on a couple IPOs. That was not genius. And I was crushing Jeremy Grantham at GMO at the time because he was making 6, 7%. But the irony is he was a far more successful portfolio manager than me, this 28-year-old moron, getting lucky on a momentum trade, which I give myself credit for seeing the momentum and the sentiment and getting the IPOs and making the money, and very smart to get out when I knew it was a bubble. But Grantham never got in. And people say, well, he was too conservative. No, he is an example of a smart risk manager. I was an example of a dreamy moron. I see that same type of dreamy moranity, what Charlie McKay would call the madness of crowds right now. And I'm all in favor of speculation. But even I, in the dot-com bubble as a 20-something, knew that I was lucky, not smart. What's happening now is a lot of people think they're smart and not lucky, or that they've got this new meme. In my day, it was the dot-com of everything. I remember pets.com and toys.com. I remember all that. Now it's the AI of everything. What Jeremy Grantham, who's been retired for 15 years, has come out and said, and he said it many times, don't forget mean reversion from Bob Farrell. Don't forget, in the height of this bubble, the market crash in 1929 didn't recover until 1958. The market bubble of 72 didn't recover until the mid-90s. The tech bubble, of which I was the unique beneficiary of, didn't recover until 2011 if you didn't get out. And the Nikkei, the biggest of all disasters, didn't recover for 30 years. So that is all forgotten, because I think what Jeremy Grantham is also saying, he's learned 2 lessons. That man tilts towards good news. That's the first thing. And I certainly did as a 20-something chasing IPOs. And that man has no interest in the long term. And right now, those 2 warnings I see as a former risk asset manager. I've never seen such a paradoxical market, such an optimistic market, but such an ignorant market of those 2 things, not looking longer term and being only interested in the good news. I have been openly, publicly bullish in 2020 and 2024. That didn't stop me from saying also these markets are ridiculous. Be very, very careful if you don't know how to trade them. And so I am not making fun of speculation. I'm not even making fun of Bitcoin as a speculation tool or as a store of value, which it isn't. But I'm saying this is what's very scary too, as another symptom, are these market bubbles, which we call a sign of economic strength, are actually a symptom of something far more dangerous. And again, history rhymes. This market doesn't have to crash to zero, but if it mean reverts down 60, 70%, and if it does take more than 10 minutes to recover, unless we print zillions to support it and debase the currency, that to me is just another sign of something broken. And anyone in any hedge fund, any bank, any RIA, any home computer who trades the markets looked at the correlation between Fed liquidity and the S&P, sees that the reason this market is seeing what Hemingway warned is the temporary prosperity of debt and an airbag from money printing and rate reduction, which we've had 40 years of. You see the correlation. This bubble isn't based on earnings. It isn't based on value. It isn't based on even real technology. AI is no different than railroads It's no different than .coms. It's no different than electricity. It's no different than the internet. All of those things were new, sexy, and revolutionary, but eventually became overbought and oversold. This is no different. The AI meme, it's extraordinary technology. It's undeniable. But the irony is the 7 companies that are completely keeping the S&P afloat are overly invested in AI, and they cannot maintain their net income margins forever. And when those 7 companies start to see net income margins fall, that's a signal. When you see that, this bubble, like every bubble, will do what they all do, mean revert. Again, not the end of the world. Piepenburg says the end of the world. No, it's just constructive destruction. And this market, like this dollar, is a symptom of that temporary prosperity followed by the permanent ruin of currency debasement and of course, war, which is another symptom. Because when nations are weak, they're also desperate. And when other nations see other nations weak, they take advantage of these things, or they distract the population with foreign policy disasters, whether it was withdrawal from Afghanistan or whatever you want to pick. That's a debate for everyone. Or the war in the Ukraine or the war in the Middle East. I'm not here to solve that debate, but we can't deny that currency debasement and war, as Hemingway warned, is everywhere. And it's the biggest fear with the family offices that I speak to across the board, across the world, inflation and geopolitics. That's the biggest fear. And of course, gold rises in that backdrop naturally.
So Matt, one of the things that I don't think you and I have particularly spoken about is what role silver plays in this, let's say, revaluation of all of this debt as well.
Yeah, I mean, look, people always call silver the poor man's gold, and I call it really the smart man's silver. And silver, even Egan and I talk about, we don't talk about it enough. And it's a real important asset. I think platinum, too, is a very important asset class to talk about. Again, we look at wealth preservation as our most important thesis. And for us, gold is a no-brainer for that. Egon bought gold at 300. It's now well above 3,400. So you could say he got the speculation benefit of a lifetime, but he never looked at the price. He just knew it held its value better than the dollar or the Swiss franc even. And so he was just a wealth preservation guy who also got the added benefit of a massive outperformance. And again, the S&P, the bubble we've seen for the last 25 years, gold has outperformed the S&P in total return. And yet the consensus on Wall Street for the last 25 years is gold is too volatile. U.S. Treasury is the worst performing asset in 5 years. It's lost 50%, but gold is too volatile. That's all other question. But so for us, gold was always a preservation asset, always was throughout history, doesn't move in a straight line. It just holds its value better than paper money. That's that simple. Silver does too. It is a monetary metal, but it's not the same as gold. Right now, it's acting, I think, more like a base metal almost. It's really acting like an industrial metal, but it is still a monetary metal. And these are the things that I look at with silver, because it does have, in a bull market in gold, a much better speculation play and a much better rate of return or speed of upside. And although gold is up significantly in this year and silver is too, we're not seeing those compressed gold silver ratios that we saw in 2011 and 1980. 1980, I think it was 15, and in 2011 it was 32. We're still not close to that. So why isn't silver ripping? There's a couple answers. You could say apologies from a precious metal guy. I think the gold market hasn't really begun its bull market yet. And so I don't think silver is going to start ripping past that juggernaut of gold like a little speedboat, simply because I don't think really gold's even in chapter 2 of its real bull run. That's the first thing. Technically, silver has a 45-year cup and handle formation that's waiting to rip. If you're a technical person, you're a speculator. I don't even look at silver as a speculation asset. I still think it's a better store of value than most other assets. But yes, it has that speculation profile. It has a 4 to 5 year supply deficit. I mean, there's not enough silver on the COMEX to even short silver like they could in the past. We get into that. But it also is the global market cap for silver is just 1/2 of NVIDIA's current market cap. The entire global silver market is 1/2 of NVIDIA. So in any significant, doesn't even have to be very significant, uptick in demand in that market of silver is going to send the price up massively. I mean, there's been 80,000 short contracts on the COMEX, and the London float, which means the available ounces of silver, is at 155 million ounces. But that's not even a day's worth of trading. I mean, it's very thin. The ability to short silver is getting very, very hard. And so I think silver, even despite its great returns relative to many other assets, hasn't even begun. And I think it's an amazing value play. Even measured in gold is an amazing, like all metals right now, measured in gold is an incredible value. And I think it will follow. But I think you should see a 4x rise in silver just on demand before real currency debasement even kicks in. So I see silver as not the poor man's gold, but the smart man's silver. As Rick Rule said better than anyone, silver rewards infrequently but extravagantly. It's already been rewarding to those. If you're looking for that 15 gold silver ratio, it doesn't come without a lot of volatility and stomach churning moves. As Egon jokes, it's not for widows and orphans. It is more of a speculation profile. But I think silver for a long-term investor, and for myself included in my family, is a play that I'll allocate to. And when it really rips and I find my out, whatever that is for each of us, our exit strategy, our ratio, I'll just buy more gold with the return I get on the silver. I think platinum, again, more of a speculation asset, you could say, ignored for a long time. People forget that platinum, had a 1-to-1, even a 2-to-1 ratio to gold. There's only 200 tons produced a year versus 3,200 in gold. The argument for many years was that platinum is dead. There's no more need. There's no more catalytic converters in the green new normal we're going to. But look, AI is sucking so much energy. I think there's going to be a huge need for platinum, and I think it's massively underpriced. And I think if you look at what U.S. and China are doing, they're stockpiling platinum at massive levels, and there's zero liquidity. There's 3 million ounces being traded in platinum on these exchanges. There's no platinum there. So there is I think a value there again for the more aggressive metals speculator, value investor who has the patience to stomach that type of volatility. There's a long-term play in platinum. There's a much more obvious play in silver. But again, for wealth preservation, yeah, we're gold. We're primarily 80% at least focused on gold. But as I used in Egon's example, he was all wealth preservation in that boring analog pet rock 25 years ago at $300. Well, Gordon Brown was selling gold and selling his country short, basically destroying it. Egon was patiently stacking it, and a lot of it. And he has made a huge amount of money on the appreciation, but he's never bragged about it. He's too modest. But the real play for him was never the price. Never looked at it. In the years I've known him, he never looks at the price. Doesn't care. He knows it holds its value better than the Swiss franc or the U.S. dollar or the euro or the yuan or the won. And that's boring, but very, very effective.
Mm-hmm. It's interesting that you bring up this idea of how quickly, let's say, we're getting this price appreciation, both in, whether we're talking about gold, silver, or platinum. And I think the fact that we're not getting this overly sensational, crazy spike in the metals where we get this short squeeze that's been talked about so long in silver, and it quickly goes up to $50, $60 an ounce. I think that ends up actually being a far more positive situation, not necessarily just for the metals, but also for the industry around the procurement of these metals, right?
No, it's a very fair point too, and I think it's a lot of things to unpack there. It is interesting that people think it's clickbait or crazy, and I don't think it is for Andy Schectman with a straight face, or Michael Hartnett with a straight face, or even you could argue Scott Bessent and JD Vance to say we may revalue gold significantly higher than spot. I don't know. I see the case for it. But the idea of gold at 24,000, which seems like clickbait, but we had no problem watching Bitcoin go from 0 to 100,000 in a span of 10 years. That's okay. But God forbid if gold got that high, because that would be terrifying. That would destabilize the world. It would, because that's how important gold is. And yet, would we have to worry about gold confiscation when it outperforms everything else and it is priced at a number that would make Bitcoin wince? We have no problem with Bitcoins because it's not a threat yet to the system, or probably ever, but that will upset the Bitcoin camp, and I understand. But gold at the Bitcoin price would be terrifying to the world, and it would destabilize every fiat currency, because that would be the ultimate sign that paper money is dead. Bitcoin is flirting with that thesis. It's a very similar thesis to gold. 80% of the conversations I have with Bitcoin owners is nodding our heads. Yeah, I agree. This is a problem. Debt, currency debasement. The government's desperate. We need alternative currencies. We need something outside of the system. We need some blah, blah, blah. We won't get into that rabbit hole, but we're very similar. But no one seems to really mind Bitcoin ripping to those price levels. But when gold gets even near 3,500, the world starts to wonder what's crazy. But to your point, it makes, I think, gold, it proves that it's a more stable BS detector than some of the meme coins and altcoins going around right now. I think the most important thing, and this is where Alistair McLeod and I and Egon, are totally in agreement. Most of the people in our industry are in total agreement. Is, it's when you call this a gold bull market, it's really a significant, serious misunderstanding of gold, because it's not a gold bull market. It really is. It's doubling in price in 18 months, but it's really a signpost of a fiat money, not just the US dollar and the world reserve currency. It's a signpost, of a debt crisis, and therefore a currency crisis to monetize that debt, as old as history itself, going back from Rome to 1990s Yugoslavia. This is not a gold bull market. It is a fiat money, not just bear market, but jig is up moment. Again, not the end of the world, not the end of the dollar, just a massive repricing, and probably at some point a massive deck chair shuffling on the Titanic and some type of dysfunctional global reset, which is inevitable. But it really is. And I think the signposts weren't just when gold went from 1,600 to 3,200 and then 34, and then the futures market at 3,500 on the tariffs. It's a signpost from 2014 when the world slowly, like an army preparing for war, started stacking ammunition before they declared war. Since 2014, we've been arguing for years. Central banks have been net selling U.S. treasuries. China's dumping them again now, and net buying physical gold. By 2022, when we had an obvious weaponization of a neutral reserve asset for political reasons, love it or hate it, pro Putin, pro Zelensky, whatever camp you're on, when we weaponized the neutral reserve currency, the world reserve currency, central banks tripled their gold purchases within minutes. And again, not alone. That was a watershed moment. I wrote an article the day after that saying everything changes now. Again, not alone. I'm not taking credit for that. That wasn't a crystal ball genius. That's just common sense. You weaponize this currency. It's a currency already unloved, already being net sold in the treasury market, and now you weaponized it. At the debt levels we're at, of course the world's going to start going to an alternative store of value. This is not a gold bug argument. It's the flow of money. At the same time, the BIS is slowly signaling that we're going to have gold as a tier one asset next to the laughable comparison of the U.S. 10-year treasury, which is a negative returning bond, which in my opinion is a defaulting bond when measured against actual, not misreported inflation. So again, these things are so obvious with gold, and it is more stable than some of the other alternative currencies that are out there. And its direction is slow and steady. It's not laughing the loudest. It's just laughing consistently at BS calling, debt levels, and paper money levels. And not only are gold bugs like us executives who've been here for decades saying the same thing, recognizing it, the BIS is recognizing it. The IMF, in the midst of the COVID hysteria, when they called for a new Bretton Woods 2.0, which is a wolf in sheep's clothing, a more centralized currency, the badness of that, the only good part of that is they recognize that behind that, the base of that is physical gold. In other words, it has more credibility than IOUs from debt-drunk countries and their currencies. So these are not gold bug cases. This is the IMF. This is the BIS, the beast, the dark stars of an already corrupted banking system, admitting and confessing out loud that we need something real, money, not currency, to back this new evolving system out of a broken system. And again, even Judy Shelton is talking about gold-backed U.S. treasuries. That's not a sign of faith in the U.S. dollar. That's a sign, like everyone else, paper money is less credible. And it goes back to your point. These are all symptoms, but they're also proof that gold is slow and steady, not just that pet rock or the thing that the financial industry laughed at deliberately and misunderstood deliberately and miseducated deliberately, from Harvard Business School to the private wealth management office at Goldman Sachs. They don't talk about it. But now it's undeniable. And again, this is me selling my book. Fine. It's selling my book. Does it mean I'm saying gold goes only up and to the right and it goes to 50,000 in a revalue? No, it's just holding its value more than paper money. And anyone, whether they have $50 or $50 million, has to recognize that. And they have to look at gold as some type of insurance for openly burning currency. And I think relative to the broad money supply and relative to inflation, gold is still a good value even at these prices. And I don't think gold's even begun its gold bull market. And no, gold doesn't go in a straight line. There are demand killing events. Francis Hunt has been talking about pullbacks in gold. But if you're looking more than 10 minutes into the future and you're trying to create legacy wealth for your family or protect yourself from dying money that you measure your wealth in, gold as an allocation should really be obvious to everyone. And it is becoming more obvious, I think, Tom.
Mm-hmm. Well, Matt, obviously we're unfortunately in good company because I agree with exactly what you kind of wrapped up with there. And that's why I think it's important to, go back and challenge these assumptions, challenge, if we are getting to the end of this road, if it is in fact, or if not the end of the world, all of these things, because,
right.
I know myself personally, I've been wrong about this for a long time. And, looking at and considering that the gold chart does really go in one direction, that debt has only gone in one direction. I don't necessarily think that this changes overnight.
Right.
And that being considered, it, like you said as well, it's not an overnight process for gold to capture that value either.
No, for sure.
Matt, as we wrap up here, is there anything that you'd like to leave our listeners to think about?
Well, I think I'm like I said, I love that you're asking questions that are past doom and gloom. I think scare tactics in any industry are not effective, although that's very common. Certainly, distracting or fear tactics are great for desperate governments. I think if you're trying to give fiduciary advice in an asset class for which you have a clear bias, you've got to have conviction as well as bias, but that the audience should always challenge any view. I spend most of my time thinking where I could be wrong on gold, and I do, but I have personally the benefit of history and math to give me some conviction. And I think it's up to people to make that decision. You should challenge people who think gold is a pet rock. You should you should look at people who think gold's a pet rock. You should look at people who are making a case for a demand killing event in gold. What if a meteor with a ton of gold lands on the planet Earth and then gold supply triples? Well, yeah, of course. I don't want to say all you need to do is buy gold and you'll be rich and happy and never have a problem. I just I think it's very important to get your own opinion. Many of us in the industry came to gold from risk assets, from stocks and bonds, currencies and rates, and we did that not because we saw an opportunity to make money, but we saw a trend in where money was going. And I think that gives it a lot of credibility. But there are a lot of newcomers to the space who will scare you and clickbait you and promise you and tell you there's no risk or that it's going to the moon. I'm not one of them. Again, gold doesn't go in a straight line, but because debt and currency debasement is trending obviously in a southern line, gold is in a northern direction. You need to consider it for a long term, not a short term trade. Trading gold is very different than investing in gold. And do your own homework. And look at Bitcoin, look at altcoins. There's plenty of smart there too. There's plenty of arguments there for freedom and efficiency and separation from the system, that gold is a good store of value, but Bitcoin is better. I would argue differently, but you should look at different arguments and come up with your own decision. And I think our role is just to be as informative as possible to shape other people's opinions so they can make their own decisions. I don't want to be known as the end of the world gold guy. I hate that. But the world is changing. And it's been changing. We're not even predicting anymore. We're reporting on the changes. And I think that is fair. And I think we shouldn't be terrified, but we should be prepared. There's a big difference. And we should be informed and not emotional. I think that's true of gold as it is on politics or social issues. Get informed before you start screaming out an opinion. And that's all I'm trying to do is give an informed opinion.
Yeah, the way I put it is I always try to stay away from the sensationalism. Try to make the decision from a non-emotional state, as you just mentioned, and also try to get away from the, for lack of a better word, the religiosity of this asset class. There is and are a lot of positives for it. I'm not saying there's not, but at the same time, I want to be trying to challenge these ideas and try to consider where we might be wrong, as you so rightly said.
Absolutely.
Matt, always a pleasure to speak with you. It's always excellent to, throw these ideas back and forth. Of course, all of your articles and writing, as well as Alistair's, Ronnie Stofferle, Egon's writing, all available at vg.gold. Matt, excellent conversation as always. Thank you so much.
My pleasure, Tom. Thanks again.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.